Wall Street is partying right now, completely ignoring the fact that the Middle East is holding its breath. This dual-axis chart tracks the S&P 500 and Nasdaq. Since the April 7th ceasefire, both surged 7 to 12% to all-time highs of 7,022 and 24,016. Even the Dow turned positive. But reality check. As this red line shows, the truce expires in days. Looking at energy, oil prices cooled, dropping from a mid-March peak of $120 a barrel down to the $94 to $98 range. That cooling is entirely relative, though. Those prices are still roughly 30% higher than they were before the war started. Talk to traders today and get two distinct stories. Half are aggressively buying a perceived market bottom, expecting these record highs to hold. The other half are openly skeptical, warning that the market is ignoring severe ongoing risks. We need to figure out if this current market rally actually reflects a locked-in peace agreement, or if Wall Street is just betting on hope. Those 7 to 12% gains sitting in your portfolio right now are built entirely on a temporary 2-week pause in fighting. You have to decide whether to ride this rally or build a defense in case talks fall apart. To understand the actual risk, we have to look past the ticker tape. Analysts at Evercore ISI point out that massive structural issues in the region remain unresolved. The physical threat is still very real. None of the active ballistic missile capabilities have been neutralized or decommissioned. Then there is the political gridlock. Sanctions relief, a primary demand to secure lasting peace, hasn't been negotiated yet. You also have heavily armed regional proxies operating entirely outside the control of the primary negotiating countries, acting as total wildcards. But the absolute highest stakes risk on the map right now is the Strait of Hormuz, and whether Iran will genuinely commit to keeping it open to global shipping. Even Vice President Vance has weighed in, publicly calling the situation a fragile truce. For average Americans balancing household budgets, this matters immensely. The stock market rally is currently masking the underlying shock to the global economy. Trusting this rally means assuming these deep military and political conflicts are already solved. If talks fail and those assumptions collapse, your investments are highly exposed. You might be hearing talk about a soft landing, and it's true. If this ceasefire holds, the American economy benefits from lower inflation. This graphic illustrates a critical historical rule. Every 10% drop in the price of oil reduces overall inflation by 0.2 to 0.3%. Since we've seen roughly a 20% decline from peak oil prices, the math suggests inflation could ease by 0.5% up to a full percent by June. But that calculation has a fatal flaw. It mathematically depends on the Strait of Hormuz remaining open and completely unobstructed. Citadel CEO Ken Griffin has been extremely direct about the global economic stakes. He warned that just 6 to 12 months of continued closure in the strait would trigger a guaranteed global recession. So the market's promise of inflation relief relies entirely on one highly vulnerable maritime choke point. That makes the current optimism an incredibly fragile gamble. Let's look at exactly what you should do to protect your money. Here are 5 actionable steps to take before the deadline. Step 1. Don't let the fear of missing out tempt you into over to equities right now. Step 2. Avoid energy stocks. If a deal sticks, margin compression will accelerate. Step 3. Execute your 401k rebalancing plans immediately. You need to lock in those adjustments now, because once that ceasefire window closes, heavy market volatility could return overnight. Taking these defensive measures might mean sacrificing a little bit of peak upside if a lasting peace actually occurs, but building this defensive strategy acts as a critical firewall to protect your entire retirement portfolio from a sudden market collapse. Step 4 is for everyday consumers managing a budget. Monitor your local gas prices on a weekly basis. Watch the pump closely. Any sudden major spike in gas prices is your early warning system that backroom diplomatic talks are deteriorating. Step 5. Prepare for 2 distinct outcomes branching out from the April deadline. Path A is a slow-moving soft market if the ceasefire is simply extended. Path B is a violent portfolio correction the moment negotiations collapse and fighting resumes. The clock runs out on April 21st. Hope is not an investment strategy. Wait for the hard data to confirm the diplomacy. And do not let Wall Street's premature euphoria dictate your financial safety.